Hello. Hi, everybody. Welcome to my live webinar. Hadi Shafiq here from SmartFX. Today, we are going to be talking about the Forex market. What is the Forex market? So, hopefully, you guys are excited as I am. Let's begin. So, before we get started, let's get this out of our way. Please follow us on all of our social medias, whether that be LinkedIn, Instagram, Twitter, as an X, or Facebook. And you can watch our content on YouTube as well. And for those who want it, that's my personal number below. You can contact me anytime with any queries or questions you have regard to the market or generally anything. What is the foreign exchange market? So also known as the Forex or FX market, it's a OTC place, over the counter, global marketplace that determines the exchange rate of world currencies around the world, where people are buying and selling forex currencies. So whether that be euro, dollar, euro, pound, GBP, CHF, okay, any currencies, whenever it is exchanged, that is included in the forex market. So people basically come here to speculate. There are many entities, many sorts of participants in the market. As mentioned below, there are banks, there are forex dealers, there are commercial companies, there are central banks, investment management firms, hedge funds, retail forex dealers, investors. So, what are they? Banks, as you know, are lower than central banks. They're private and public, basically companies which lend out money, which give people credit cards and everything, but they have a massive involvement in different currencies. They have a massive exposure to different currencies. Like there are dollar accounts, there are pound accounts, there are various other ways they have this exposure towards the forex currencies because they themselves are buying and selling as well. So they are also heavily involved in this market. Forex dealers, what are forex dealers? So forex dealers basically have a medium to a large client base, and then they are managing their flows. So people forward their orders to them. So many people who are trading already with them, many institutions trade with them. So what they do is they are also heavily involved in this market, forex dealers basically. So commercial companies, central banks. What are central banks? As you guys obviously know, they basically control the money supply of the nation. Every country has a central bank. There's a lot of noise going on about like cryptocurrencies nowadays, but till now, central banks are the major powers around the world which control money. So each country has their own central bank, and each central bank has the authority. They can regulate the markets, they can influence the interest rates, and when they increase interest rates or decrease interest rates, launching policies, it affects the currency value directly. So, for example, if I have there's a central bank of America. When they increase the interest rate, what happens? So it means basically to lend the money, you get more interest. So you make more money. So what they do is they would rather keep that money, give it to the bank, because the bank will be paying them more interest with the banks. So that thing directly affects the foreign exchange of the world, of that specific currency against all the other currencies. So if, let's say dollar increases the interest rate, so dollar will generally go up against all the other currencies. So whether that be dollar, British pound, whether that be Indian rupees, any currency on the world, when they increase the interest rate, what happens is basically that currency becomes stronger. Because to basically hold that currency, you get a higher interest. Investment management firms, hedge funds, they're similar. They handle other people's money and they invest in the market for them to generate a return. They have their own fees and their own structures and everything. So their sole motive is to generate a profit while trading the market, speculating the market. Hedge funds tend to use less risk strategies. So what they do is they try to offset their losses with other positions. They try to have a low exposure to the market and just make a very small profit, but consistently. day to day, week to week, and generally they want to beat the market, and that is the making of a good hedge fund. Retail forex dealers, there are major forex dealers, then there are smaller forex dealers. So retail ones are basically a smaller version who are managing a smaller portfolio compared to the larger ones. The dealers basically just manage the flow of the orders coming to them. And investors. So generally, investor is like a generic term. It is a very big umbrella. Under that, you can get the average person who's investing a couple of $100, even to the person who's investing a couple of millions of dollars. So average investors who are trying to speculate on a day-to-day basis, trying to make money in the market, because all the currencies they move a certain percentage every day. So if you're sitting on the right side of the market, you'll be making that money. And in the forex market, as you guys know how big it is, there are opportunities everywhere. So are we going back to OTC? Just to define what is OTC. OTC usually over the exchange, over the counter. So sorry, not the exchange. So sorry, over the counter. It's usually done with banks. So instead of an instrument being traded on the exchange, it's traded between two parties, specifically banks and investors. So they have some specific deals, some specific situations where they concoct such deals and then they trade it. And on that, they try to make money over it, or sometimes they have even hedging schemes on that. So OTC is the generic term also. It is a very big thing basically. And Forex is the biggest OTC market in the world. If you are not aware, in Forex, there's almost $6.6 trillion worth of volume exchanged every day. 6.6 trillion every day. Yeah, think about that. Take a minute, think about that. Basically, it is an insane amount, and it's reality. Why? Because there are hundreds of pairs all across the world, and so many institutions, companies, investors, private investors. It is just governments even getting involved in this. So you can imagine the pool of the money which is just together to trade the forex market. It is insurmountable. You can't imagine. The currencies are always traded in pairs, obviously. That is the way you can determine the value of A currency or B currency. So if you can see in like the term of Euro USD, to buy €1, you have to pay 1.07 USD or 1.10 USD, whatever the rate is going on. Same thing goes for USD Japanese yen. To buy $1, you have to pay 140, 135 Japanese yens. So these are the way of getting the value of each currencies. And obviously the currency which is stronger prevails at the end. You have to pay less of that to get more of someone else's currency. The Forex market was also called the FX market, the currency market. It was formed actually for the growing global economy. Largest market in the world, repeating that. In terms of units being traded. So units are simply if I say 1 unit, that means $1 if I talk about dollar terms. So if I say 100,000 units in dollars, that would be like $100,000. So when you calculate by units, it is the biggest market in the whole world. And the forex market also enables currency conversions for international trade settlements and investments. I hope you have gotten the general idea of what it is actually. So we're going back to the pairs part basically right now. So for example, forex currency pairs also determine the power of the currencies against each other. And because of this market, there's a high liquidity across the world because it's so easy to get into forex. So what happens is, for example, if we take India's example, Indian currency is weaker than dollar. And why do we go back to dollar always? Because it is the industry standard. It is the world standard. Every currency is traded against dollar to find out its value. The strongest currency in the world is not dollar in terms of value. It's Kuwaiti dinar actually. One A dollar will get you like 30 cents of Kuwaiti dinar. But in terms of global presence, political influence, dollar is the most powerful currency. See, there are two types of currencies. One is called free float, and one is called a fixed float. A free float is basically its value determined by free market forces such as supply and demand relationships. So, for example, if in a free float, one currency's demand increases, so the value of that currency will increase. And if another currency's demand decreases, the value of that currency will decrease. But in a fixed float situation, there are a couple of examples like the Panamanian Balboa, Saudi Riyal, even United Arab Dirhams, AED. These are pegged against the dollar. So no matter what happens, the value of that currency will not go up and down. It will stay the same. I think Saudi Riyal is 3.75. So $1 equals 3.75 Saudi Riyal or SAR, they call it. And when we take dirhams example, one dirham is 3.672. And this has been for many years. It is called pegged currencies. In this situation, it's more easier for these countries to trade because they don't have the risk of currency fluctuations with each other. But if you take another example, like let's say pound against the dollar or euro against the dollar, these are basically free float. So it's all going to supply and demand. Some policies coming out, some news comes out, instantly affects the market. The price moves, exponentially at the moment. So goes for Japanese yen, CHF. Dollar is pegged with very few currencies around the world, very few. One of the most unique features of the market, of the Forex market, is that it is open 24 hours a day, 5 days a week. So you can imagine how highly liquid this market is. And it is a major hub for transactions, for investments, and it is the largest asset class available to investors. So again, liquidity, margins are low, commissions are low, charges are not so high. This is usually the things the investors look for when you get into a market. Easy to transact, easy to get in, easy to get out. For example, if I give you an example, just to define how important liquidity is, even the real estate market, even though it's such an amazing market across the world, when you buy a property and you want to sell it again, to even buy, it takes a couple of days. In some countries, it takes a couple of weeks to get to that investment. And when you want to liquidate it, you have to find the buyer, you have to wait for it. And that can take days, weeks, even months. That is not the case in Forex. No matter the volume, because it's such a heavily traded market on a daily basis, whether you have a couple of thousands or a couple of billions, even in a single Forex currency pair, and you're trading it, that gets you instant execution. And whenever you feel like cutting the position, you can cut it at any time. That is what we call high liquidity. You can deposit, you can withdraw anytime. That is a highly liquid market. The most liquid trading pairs in descending order. Number one, Euro USD, biggest economies in the world. USD JPY, they are very, very old import-export partners. They have heavy trade amongst each other. And pound and USD. These are the three most heavily traded, most liquid pairs in the market. They're also really good to trade. Like if you want to have the lowest cost possible in Forex, if you go to any exchange, any broker, anywhere, your USD will have the smallest spread always due to high liquidity. Let's talk about something interesting, leverage. I would prefer to call leverage as like a two-wedged sword. So what happens is that in the Forex market, a person can just put down a margin or a certain percentage of the actual trade he wants to take. So for example, he wants to trade $100,000. What he will do, there's an example over here. If he wants to trade $100,000, and the broker is willing to give him 1 to 100 leverage or 100 to 1 leverage. He doesn't need to put down $100,000 to trade it. He actually just needs to put $1,000 because the broker is going to lend him the rest of the money to open the trade. Now, this is not lending in a sense where you can just, you got the money, you can withdraw that. No, no, no. You have the access of that facility, of that service. It's a part of the service. So when with $1,000, you take a trade of $100,000, the effect on your money, on your account, on your transaction will be of $100,000, not $1,000. So you have to keep this in mind. It is good for you and it can also be bad for you. So for example, you have $1,000, you put in the account, you start trading, you take a position worth $100,000 and the market goes in your favor, let's say any currency, it goes in your favor by 1%, you have literally doubled your money because you made $1,000 profit. Now, if God forbid, the market goes opposite, let's say it only goes opposite 0.5% against you, you would have lost $500. And that would be half of your actual investment. So you should keep this in your mind when getting into the Forex market. Leverage is not always good, but it is very useful. And it is one of the advantages, as well as you can say disadvantage also of this industry. But if you know how to use it correctly, properly, then sky is the limit. It's literally using someone else's money to make money with your a certain amount of your margin kept as safety. It's literally that. So when people do it with bigger amounts of money, bigger funds, you can imagine how much money they actually make from this. Obviously, there are losses on the way, but if you manage it properly, it's quite lucrative. There are types of, these are the three types of foreign exchange markets: spot forex market, forward forex market, and futures forex market. Spot market is the immediate exchange of currencies. So when I say spot, it means the actual price of the currency right now. Most of the people trade the spot market. Whenever you hear the word spot, it means the actual price going on right now in the world market. A forward forex market, it's like OTC. So it's done with banks mostly or private institutions. So in this situation, what happens is there's an agreement between two parties where they kind of fix the rate of a certain currency at a future date or whatever date they specify. There's some cost, some premium for this, then they put down some margin. And in the future, for example, I want Euro USD next month first. And I know at the rate I'm getting right now, it's going to be a good rate, but I want to just fix it right now. I want to stay, tension free for the next 15, 20 days that the market movement should not affect me or the currency which I'm going to use. So I'll go to the bank and I'll say, okay, this is the rate. I want to fix it, create a forward contract for me, and they will give you the facility. And once the rate is fixed, now regardless the market goes up or down, you become safe. You're out of the market in a sense. You have fixed the price. If it goes up, you won't have any risk. If it goes down, you won't have any risk. The third market, futures market. This is similar to forward market, but it is direct from the exchange directly. You get a futures price from the exchange directly. And there's a certain commission charge to trade this. And it is more regulated because it's the exchange. And it is also used for hedging. So people manage their risk currency exposures using futures. And it is, in a sense, you can say it's more liquid because the live rate is coming out, all the time, whenever the market is open. Advantages of Forex market. There are fewer rules than in other markets, which means investors aren't held to the strict standard regulations found in other markets. So fewer rules meaning more leverage. You can find specific deals in the market. You can find low commissions, low charges. Most investors won't have to pay the traditional fees or commissions than they would on another market. Market is open 24 hours a day. at any time of the day, one of the advantages. And finally, if you're worried about risk and reward, you can get in and out whenever you like. That's what I told you guys. But again, be careful of leverage. You have to keep that in mind. Don't get too excited. So generally, a new trader comes in, he gets overwhelmed, like overexcited, and then some problems occur. It's better to control your emotions in this scenario. So the market being unregulated brings advantages. It also creates risk, as there is no significant oversight that can ensure risk-free transactions. So basically, there are pros and cons which you have to weigh before getting to the market. And last, leverage. It can help magnify profits, but also can lead to high losses. By the way, there are specific tools which can limit your losses also at the platforms where Forex is traded, foreign exchange is traded. So if you utilize them also well, to the least you can minimize your losses. So if some trade goes negative, you're already prepared for that, not just mentally, practically. So unlike stocks that also pay you a dividend, FX are solely based on appreciation and depreciation. So there is no fixed dividend which comes out of it. No, you just have to trade it, speculate it, and on that basis you will get your benefits. And you can also short the market as well, if you keep in mind. So not always you are thinking that certain currency is going to go up. If you feel certain currency is going to go down, you can short it. There is lack of transparency a little bit in the FX market. And that means what? Because it's such a big place. New policies are being made. So, when the policymakers are talking to each other, we don't have access to that stuff. So, they say in our field, you should buy the rumor and sell the news. But as soon as the news is out, it's already too late. So we have to act with limited information. It is risky, but that's the part where you can benefit. If it was not risky, then everyone would do it. So three types of Forex markets, basically: spot market, futures market, and forward market. And then there's a swap market and the options market. Options are basically you have the right to trade, but you don't have the right to physically attain it. So usually people just pay certain premiums. It can also be considered like an insurance. And the swaps market is basically based on interest. So the functions of foreign exchange are to facilitate currency conversions, manage foreign exchange risk for futures and forwards, and for speculative investors to earn profit of FX trading. So when they say manage foreign exchanges, like we said, we have been through before, the forward market and futures market where people hedge their currency exposure, that's how they manage risk, futures and forwards. And all of these instruments are available for regular investors as well, who want to just trade it to make a profit out of it. It's like a facility which you can avail. The importance, what is the importance of the foreign exchange market? To be frank, if foreign exchange market was not as liquid as today, the costs would be higher, transactions would be lower, smaller, and it would be like a crooked system. But thank God, the global trade which is going on through these currencies, they create actually a big opportunity pool for everybody. Even foreign Forex does not just stick to just money and cash, it affects all the other goods and services. So when they're businessmen doing, money transfers, buying goods in other currencies, that itself also affects Forex currencies. And these facilities, these forward contracts, these future contracts help them manage their money also. So it's a blessing basically, all right. The bottom line, it is the largest market in the world where anybody can trade, anybody can get into, and anybody can participate. There are risks involved, but the risk and reward ratio, if it's set right, if it's set correctly, can be extremely lucrative for you. And if it has been going on for decades, it will be going on for a long time in the future. Previously, actually only large institutions used to trade. The average person did not have access to it, but now anybody can get into it. So tread carefully, and this is basically what the Forex market is. If you have any other questions, again, that's my mobile number. You can contact me anytime you like. And just a reminder, please follow us on our social medias so you stay up to date with our content. It was my pleasure. Hadi Shafiq signing out.